Hello everyone. In this video, we're going to be talking about the advantages of dividend investing. And make sure to stick around to the end of the video where we're going to touch upon some of the risks that are really important to understand before getting started with dividend investing. All right, let's jump right in. The first advantage of dividend investing is that there are two ways that you can generate returns. The first is that the stock can appreciate in value, meaning the stock price can go up. I know that's not groundbreaking or anything because that happens with stocks that are non-dividend stocks as well. And the second way that you can see a return from dividend stocks is that dividend itself, that regular dividend payment that you receive for owning the stock. Let's look at Home Depot as an example here. Home Depot is currently priced at $273 a share. 5 years ago, it was $116 per share. This is growth of 135% over the course of 5 years. Now, they also paid out a dividend each of the past 5 years, and they also managed to grow that dividend by 23% per year over that period. Over the past 5 years, for each share of Home Depot that you owned, you would receive a total of $21 in total dividend payments. So the total return if you bought Home Depot stock 5 years ago would be around 155% if you take into consideration the increase in the stock price and also the dividend payments over the past 5 years. This is just an example here. It's not going to be the case with every stock that you're going to see these types of returns when you're investing in dividend stocks. However, it's a really nice example that shows that you can get returns from the stock price going up and also from those dividend payments that potentially are increasing over time. Another advantage of dividend investing is that those dividend payments are truly passive income. Once you invest in the stock, you'll receive regular dividend payments without having to do anything. This is one of the most passive forms of income there really is. And from there, you can decide to take those dividend payments and reinvest them in the stock and buy more shares of the stock, or you can use those dividend payments to pay for expenses or use it for spending money or whatever you want to do with it. But I personally really think it's a good idea to reinvest the dividends so that way you realize the compounding effects of the dividend payments that you're receiving. And before we move on to the next advantage, if you like stocks and investing, make sure to hit the subscribe button and the notification bell, and you'll be alerted whenever I release a new video. All right, the next advantage of dividend investing is that when you're investing in dividend stocks, these stocks are typically lower risk than non-dividend stocks. These companies are typically more mature and more stable than their non-dividend paying counterparts. Many dividend paying stocks are also in sectors that can weather economic downturns and have lower volatility overall. To get a better understanding of this aspect of lower volatility, let's talk about beta for a moment. Beta is a measure of the stock's volatility relative to the overall market. So the S&P 500 index has a beta of 1. And the beta for individual stocks is based on how much they deviate from the S&P 500 or from the overall market in general. If we take a look at the beta of dividend stocks like Procter & Gamble or Coca-Cola, they have betas of 0.43 and 0.55. And if we compare that to non-dividend paying stocks like Amazon or Tesla, these have betas of 1.32 and 1.63. So you can see here that the dividend paying stocks have a lower beta, meaning they're less volatile than the non-dividend paying stocks. And they're less volatile than the market overall. Another factor here that contributes to the lower overall risk of dividend paying stocks is that institutional investors typically love dividend paying stocks. If the stock price slides substantially for dividend paying stocks, institutional investors will start to gobble up shares of those stocks and drive up the share price. The next advantage of investing in dividend stocks is that these stocks have the potential to outperform non-dividend paying stocks in the long run. If we look at 1927 through 2014, dividend paying stocks have actually delivered better long-term total returns than non-dividend paying stocks, with 10.4% per year returns for dividend paying stocks versus 8.5% per year returns for non-dividend paying stocks over that time period from 1927 through 2014. And not surprisingly, based on what we discussed with the betas for dividend paying stocks versus non-dividend paying stocks, the dividend paying stocks have also enjoyed lower volatility over that time period from 1927 to 2014. So not only were the returns better for dividend paying stocks, but the dividend paying stocks had lower volatility than their non-dividend paying counterparts. The next advantage of dividend investing comes in the form of tax advantages. Qualified dividend income is taxed at a substantially lower rate than ordinary income and also than short-term capital gains. The maximum tax rate for qualified dividends is 0 to 20%, and that's based on your income. And when we say qualified dividends, the IRS defines this as meeting these three criteria. The dividend must have been paid by a US company or qualifying foreign company. The dividends are not listed with the IRS as those that do not qualify, and the required dividend holding period has been met. The required holding period is typically 60 days before receiving that dividend payment. But look into this on your own, make sure that you understand what exactly it takes in order for dividend payments to be considered qualified dividends. Before we get into the risks here, if you don't have an account with either Webull or Robinhood, they're both giving away free shares of stock for opening up an account with them and funding the account with at least $100. Click on the link in the description to open up an account with either Webull or Robinhood and get your free stocks. I like Robinhood a little bit better than Webull for dividend investing because they allow for automatic dividend reinvestment, and Webull doesn't have that yet, but they're both giving out free stocks. So if you don't have an account with Webull and Robinhood, make sure to click the link in the description below and get your free stocks. Despite all of the advantages and benefits that we just talked about with respect to investing in dividend stocks, there are still risks just like any other investment. For example, the stock price can go down just like any other stock and you could lose money. Another risk is that the company can decide to reduce or completely eliminate their dividend payments. And you can see here that over 60 companies in the S&P 500 have decreased or completely suspended their dividends this year. Another thing to take note of here is that the last time that we saw a lot of companies cutting or suspending their dividends entirely was in 2008 and 2009, the last recession. So it's likely that if we're going to see dividends being reduced or suspended completely, it's going to come at a bad time. It's going to come when the economy is poor. One example of a company that reduced its dividend payment this year is Wells Fargo. They reduced their dividend payment from 51 cents all the way down to 10 cents this year. So if your entire portfolio was made up of only Wells Fargo, your dividend payments would have been cut by about 80%. This is why I recommend diversifying your dividend portfolio to make sure that any one company's performance doesn't have a huge negative impact to the dividend payments that you're receiving or to your portfolio overall. My next video is going to cover the risks of dividend investing, so make sure to subscribe so you get that video right when it comes out. And also check out the video that's on the screen here for more on dividend investing and getting started with it. All right, see you in that next video.